本节目由声动活泼制作播出。
Hello， 大家好，我是丁教，欢迎收听全新一集 What's Next 科技早知道。那这一期是浩毅主持的 SaaS 专栏。这一期浩毅和 FinVC 的创始合伙人 Logan Allin 聊了聊最近的 Fintech， 也就是金融科技的市场。那这一期是英文节目，按照惯例我会在节目开始之前给大家用中文做一下本期节目的关键观点的梳理。因为是远程录制，所以这一次的音质不是非常的好，建议大家不要戴耳机收听。另外，生动活泼正在招聘不同的内容以及商务的岗位，如果有兴趣的话，可以查看我们的 show note， 或者是在我们生动活泼的公众号下面回复暗号入场券来查看详细的岗位以及信息。好了，那下面就是我们的正式节目。根据 CB Insight 发表的2021年的第二季度的报告，金融科技公司在全球募资总数上达到了 22% 这样的一个高的数字，也就是说每5美元就有1美元进入了金融科技的领域，在第二季度达到了330亿美元，同比增长为 191%。那在金融科技领域独占鳌头的就是 To B 向的企业。那这期和浩毅一起聊这个话题的就是嘉宾 Logan Allin。 Logan 是 FinVC 的创始合伙人， FinVC 专门投资全球范围内的 B2B 向企业 SaaS 服务向的金融科技公司。Logan 有着20多年的金融从业的这个经验，在创建 FinVC 之前，他是今年6月份刚刚上市的 SoFi 的前战略投资副总裁，投资并且孵化不同的金融科技公司。那 SoFi 这个公司可能很多大家不是很熟悉， SoFi 是2011年成立，最初由4名斯坦福的 MBA 学生建立，瞄准美国名校学生贷款的市场放贷。那接待人必须是毕业于美国排名前200的学校，这个目标客户被他们称为叫做 Henrys， 就是 High Earners Not Rich Yet， 即收入较高但还没有富裕起来的人群。那最早他们的业务包括学生贷款，后期扩展到抵押贷款、房贷、个人贷、信用卡、股票投资，甚至是数字货币交易和银行服务等等。那另外一个有趣的点是 SoFi 也是人人公司 CEO 陈一舟投资最成功的海外项目之一。那一开始 Logan 介绍了美国金融科技公司的发展历史，包括几家标志性的提高传统金融银行行业效率的公司，像是 PayPal、Mint 等等。然后后面又聊到了像是最近很火的 SaaS 软件独角兽 Stripe 的崛起。那虽然很多投资人因为这个领域的严格政策监管而对金融科技望而却步，但是如果不是直接对 C 端或者是对企业端提供金融服务的公司，只是提供工具或者是技术的 SaaS 金融科技公司在最近是特别吃香的，因为他们只是需要提供中间的技术支持，并不需要被过多的监管。也是因为有了这样的一个底层思考， Logan 也分享了自己的投资的领域和一些市场的风向，我觉得大体可以总结为下面几点。第一，他会根据二级市场的动向来选择投资的标的，因为有像是老虎基金这样的大型基金不断在一级市场上出手，很多的金融科技公司在一级市场上拿了太多的投资，以至于估值太高等原因在二级市场上的表现不是很好，并不受欢迎。那数据显示，老虎全球基金在第二季度整体投资了81个项目，还不包括原有的复投的项目。那老虎平均一天平均投资 1.3 个项目。其次就是不管是早期还是晚期的项目，资本市场对更多的技术驱动的 B2B 的项目更加感兴趣。首先，这样的公司有更高的毛利，二级市场的投资人追求 60%到80% 的毛利率，那如果像是借贷的领域只有 30-40%， 就不会对投资人有那么大的吸引力了。那其次， SaaS 金融科技公司有更加稳定的订阅经常性收入，而不是像 SoFi 或者是老牌借贷公司 Lending Club 这种借贷服务，因为贷款是一种叫做 do over business， 每年都需要重新计算，非常难预测。那第三， Logan 聊到了在区块链的领域。Logan 虽然说自己从10年就开始投资购买比特币，但他并不是很相信比特币作为交易的市场价值，他更加看重的是区块链驱动的提升效率的各个技术领域。那比如说是他投资的公司 Figure， 虽然说也是在借贷的服务领域，但是他们的侧重点是用区块链和智能合约，把传统银行在过去需要120天，需要经过数个中间商服务才能完成的流程大幅度缩短。他觉得机会也同样在物流、供应链金融代替传统的资产管理的领域里面。 最后他还提到了数字货币的全球市场。他说中国在区块链领域在知识产权上面的申请数量是走在很前面的。那虽然国家在大力推广数字人民币，但是从外部看来，我们的政策还不是很明确。数字货币对于很多像是委内瑞拉这样没有稳定法定货币的国家来说，比特币这样的数字货币反而获得了更多的信任。好的，那我就粗略的给大家总结到这里，更加多的细节和准确的内容，请大家后面收听 Howie 和 Logan 的英文采访。
Hey, Logan, thank you very much for coming to my show. So I actually have an ongoing SaaS conversation with the industry experts. And people typically do not necessarily link Fintech with SaaS, but I know that you are the expert in the Fintech and SaaS. So I thought I wanted to have a chat with you, give the audience a exposure on, there's a pretty good linkage. Fintech is not just about P2P. It's not just only about Bitcoin stuff, right? There's a lot of the enterprise software play. So that's why I want to invite you here. So before we started, I started with my own question. Do you want to give a quick intro of yourself first?
All right. Yeah. Thanks, Howie, for having me. I'm Logan Allin, managing partner of Fin Venture Capital, based here in San Francisco. We have an office in New York as well, and opening up an office in London in Q1. We exclusively, as you pointed out, invest in B2B, SaaS, FinTech. And it's this really interesting part of the Venn diagram. You've got a number of investors out there investing in consumer FinTech, SMB FinTech. We call those the first two waves of FinTech. We're really investing in this third wave of FinTech, which we think about as enterprise software, is supporting incumbent organizations like banks, supporting legacy FinTechs, new FinTechs, InsurTechs, PropTech players, et cetera. My favorite stat to sum up why we do what we do is that the financial services industry spends $1 trillion per year on technology, and yet less than 10% of their data is in the cloud. So they're number one in the world in spend, and they're dead last in cloud adoption. And the fastest growth area from a spend perspective is third-party SaaS software. And you can guess that's a function of lowering their cost base and really trying to move as much of their capabilities, data, functionality, et cetera, into the cloud. So that's why we invest in this space. We invest exclusively in the US, UK, Europe, but certainly are looking to add additional geographies over time.
Thanks for the intro. Look, as you mentioned, right, $1 trillion spend, only 10% of that on the cloud. It's not necessarily true that if you are not on the cloud, you are toast. But on the other hand, the percentage or the cloud penetration is a measure that how digitized your business is. So I really like the stats. So before we go too deep, let's actually zoom out a little bit, right? You mentioned about your own investment thesis about different phases, right, of the FinTech. This is the third stage. I remember you told me before that the way you look at a FinTech, from historical point of view, right, there is a long history. Maybe you can just give us a little bit more historical perspective in more details first. In particular, you mentioned about recent evolution about decoupling and then recoupling. Can you give more insights about this topic to our audience?
Sure. So if you look at the history of FinTech, it actually dates back to 1871 in the US with Western Union, when the first money transfer service came to be, right? Moving money.
So 1871, very first FinTech.
1871.
Good to know that.
Yes, very first even remotely FinTech-oriented business was Western Union, and that was moving money with basically horse carriages and then ultimately over telephone signal, right? And that has evolved really towards the early 2000s when you had the first wave of FinTech, which I call the decoupling wave, which was principally B2C companies. So consumer-facing companies like PayPal, like Prosper, like Lending Club, Mint.com emerged in 2006. In there, you also had the beginnings of B to SMB. Square started in 2009. All these companies had one thing in common, which was they were either B2C or B to SMB, and they were completely monoline or decoupled. So you look at a traditional bank.
So when you say decoupling, can you talk about what decoupling from what?
Yep. So when you look at a traditional bank, you effectively have a platform that is integrated and they have a number of services. So when you go into a Wells Fargo here in the US, for example, you can get banking, checking, wealth management, et cetera. That is an integrated, multi-vertical, multi-channel strategy versus the initial fintechs that were all single product, single channel. And that's what I mean by decoupling. So they decoupled the traditional bank into really focusing on tech enablement with one vertical. So for example, lending clubs started in personal loans and they've persisted in personal loans. Wealthfront focuses on robo-advisory wealth management. That is this decoupling. And what you're seeing now across a number of those companies, SoFi, where I started my entrepreneurial career, is a great example. SoFi started in student loan origination and refinancing, and then started to recouple those services that you would expect from a traditional bank by adding wealth management capabilities, brokerage and trading capabilities, et cetera. And so that's what's happening in fintech. You had the B2C and B2SMB waves. They were all monoline decoupled solutions. They've all started to recouple and really add additional verticals and solutions onto their growing platform. And then this third wave, where obviously we focus, is this B2B enterprise software wave. And that really kicked off with Stripe and Plaid. Stripe started their business in 2011. Plaid started around that time as well. And we think this is going to be the largest and most long-term transformative wave in the history of fintech.
So when I kind of started looking to fintech, some of my friends told me that, hey, fintech is not that interesting because it's heavily regulated. What's your comment on that?
I agree. I think fintech is definitely heavily regulated, but I think because it's heavily regulated, that's pretty interesting. If you look at B2C and B2SMB players, they had to overcome a significant amount of technical challenges. They had to overcome business model challenges, and they had to really fundamentally change the way that they were servicing consumers or commercial customers. And they had to go and ask for permission from the regulators. So at SoFi early days, we basically invented student lending in the private markets. And so we had to go to OCC, FINRA, SEC, et cetera, and say, hey, is this cool, right? Can we do this? And so we had to ask for permission versus asking for forgiveness. And that's a big reason why we focus on enterprise software. These are companies that are not regulated themselves, but they are selling into regulated businesses. So they need to be intimately familiar with the regulations. They need to be compliant and enterprise ready in their own ways. Think SOC compliance and PSD2 and so forth. That's a key part of their readiness, but they're not answering to the regulators like the traditional B2C neobanks and B2SMB players are, which makes them much more capital light, efficient, and free from the compliance and operating overhead that you typically see.
Yeah, I think this is very good because, most people, when they think about a fintech, they are thinking about the consumer-facing kind of the fintech, right? But what you are seeing is, hey, there is actually a big part of the business. You are enable the financial business. You are the enabler technology. And that alone is not regulated. They are kind of helping people who is regulated. Their business is regulated. It's two different things. So from that point of view, you are a big fan of the enterprise customer, for the startups, you are investing. That's pretty good. So along this line, right? So we just recently, last month or so, this company called Robinhood went IPO. It's almost a $40 billion company. And do you consider Robinhood a consumer-facing, or do you consider that a enterprise company? Part of the reason I'm asking this question is if you look at their revenue, right, they don't really make money out of consumers directly, but they make money out of the enterprise. Any take on this?
Yeah, so Robinhood, in our definition, is definitely a B2C consumer business. They are out trying to acquire consumer companies. But to your point, they are making a portion of their revenue off of what's called PFOF, or payment for order flow. And that's roughly 70% of their revenue, with Citadel being the largest player. And I've been quoted in the Financial Times and other publications about the challenges I see with Robinhood's business model. model. They, have effectively tried to gamify trading, which is a very serious business, and they're doing it with consumers that don't have the sophistication or the knowledge or the training or education around just regular equity trading, but also options, which has become a significant part of their business and is even more complex. And they are also offering leverage and margin loans as part of that trading process, which means that they're gamifying trading for novice investors and then giving them leverage to do more trading. And then they're taking the other side of that trade by selling away those positions, so they're not giving best execution to those retail investors. So to your point, they have a B2B element to their business because they are selling off order flow that's generated by the consumers on their platform, but they are very much a consumer brand, and their positioning with consumers is they want to democratize access to finance. My problem with that is the way that they're structured and the lack of alignment they have with those consumers in terms of what they're providing. And, they're holding themselves out there as Robinhood. And the problem is that they're not really providing meaningful education to those consumers to actually learn what it means to trade, and particularly how to handle options and the like. So that's how we think about Robinhood, and they are definitely in that consumer bent. I think the challenge you're going to have with Robinhood in the public markets, and you're seeing the volatility in the trading, and it's become a meme stock, is that they will get comped to Schwab, TD Ameritrade, who trade at 7 times trailing sales. And, there's going to be a lot of multiple and valuation compression as a result.
So there are two things here, right? One is Robinhood as a business, whether that's really good for the novice investors or not, there is a question mark, right? But on the other hand, from the business point of view, it's almost like the traditional Google business model that they give you some consumer-facing product for free, but they kind of sell your behavior in a way to the enterprise and then make money out of it. Is that my understanding correct?
Sort of. I think with Google, they're providing obviously a really important service with search, and then they're serving up advertisements, but you as a consumer have to opt into those advertisements, right? So they've got advertisers who are big corporates and enterprise customers, spending ad dollars to get, in front of consumers who are obviously using Google for search and other features. The issue with Robinhood is you're not opting in or out. They're doing it, right? So if you're a Robinhood user, you have the ability to opt in, opt out on margin loans, certainly. But what you don't have the ability to opt in on is what's happening to your trades. And on Schwab and TD Ameritrade, E-Trade, et cetera, and all their peers, they guarantee best execution. Meaning if you set a limit order and you say, I want to buy Apple at $150 a share, which Apple's not trading, I'm just using it as an example, you're going to get at least $150 a share or better, versus Robinhood, where you're probably going to get a much worse price for that stock because they're trying to make some margin or some spread in that position, and then they're trying to sell it off to Citadel or one of their other partners who may be going short or long or the like. That's how I think about Robinhood. It's different from Google in the sense that they really are driving that behavior.
Well, in a way, you're saying that you're screwed, but you didn't know you're screwed. You
Exactly.
didn't even opt in, right? So let's focus on the enterprise a little bit. Before we talk about, what kind of the opportunities do you see, I was curious, who's the first fintech SaaS company out there?
I would put Stripe in that category. So you think about when they started back in 2011, they were really one of the first. But if you go way, way back to kind of the 90s, right? So PayPal started in 98. You had Esurance in 98. The kind of original SaaS company in fintech is Yodlee. Right. So Yodlee started in 1999. You can think about them as the first iteration of Plaid. And what Yodlee was providing was the infrastructure which ultimately Mint.com leveraged to build its personal financial management platform. And so Yodlee is data aggregation. So they went to the banks and they said, hey, consumers want to aggregate all their accounts and have a single view of their assets. And they also want to be able to move money between bank accounts through ACH and other means. So we're going to help you do that. And so Yodlee was actually the first SaaS player in 1999. And then if you think about kind of the most transformative SaaS player thereafter, it was Stripe in 2011. And the reason they were so transformative is Uber and other tech-enabled platforms would not exist without Stripe. Stripe formed a very simple, couple lines of code for payment acquirers on tech-enabled businesses like Uber, so you can pay for your ride instantaneously, like Instacart, so that you can have, point-of-sale payments processing, like DoorDash, et cetera. All these players needed a means of payments that was super easy to integrate into whatever business model they had, and Stripe really offered that. And Stripe's now the most valuable private fintech in the world, right? And one of the most valuable, if not the most valuable private company in the world. And that's how they've scaled. So I would point to Stripe as the kind of most valuable example and the clearest example of this third wave. But we've had enterprise software dating back to 99. I would also point to Visa and MasterCard. Visa started in 1958. MasterCard started in 1969. Both of those are, examples of network providers who sit in the middle and are B2B, right? They're working with merchants and payment acquirers, and they are truly facilitating, as a marketplace, credit card and debit transactions. And so I think it's pretty fascinating.
Yes, dating back all the way to 1958, the software enabling the enterprise to do such financial applications. Usually, I clearly remember that time, right? Because I was a customer of a few companies such as Fidelity, Vanguard. I remember that usually, there's a powered by usually somewhere, somehow, for this kind of the data aggregation part. So Stripe, right, $152 billion valuation just very recently, early this year, they raised around largest unicorn, as you said. There are more than that. Last week alone, right, there was another fundraising news, Chime, $25 billion, Revolut, $33 billion. But those are kind of the consumer, probably closer to consumer side. On the enterprise side, there's a Cloud 100 list. I looked at the top 10 companies. And the first one is Stripe, $152 billion. And then the other two on the top 10 list is Plaid, $13 billion, and then Checkout, $15 billion. So when I look at everywhere, right, fintech is a big component is a big portion of the entire SaaS ecosystem. I remember seeing some data about in Q2, the quarter we just finished, there was like $156 billion fundraising activity in the VC land, and 22% of that actually went to fintech. I'm pretty sure you contributed to. So maybe you can give us a little bit understanding of, 22% of a $156 billion investment. That's a big amount, right? Where are people investing? What kind of categories do you see within the fintech SaaS?
Yeah, it's amazing that such a huge percentage of tech investments now are going specifically into fintech. We think about fintech in a pretty diversified way. So if you think about embedded finance as one category, that's banking, lending, payments. Second category would be asset management and capital markets. That's things like wealth tech. It's things like trading and exchanges. It's things like market data. Third, we call it the CFO tech stack, but that is everything from budgeting, forecasting, expense management, the treasury function, and so forth. Fourth, InsurTech. So we include that within the broader fintech world, mainly because a number of financial services organizations and fintechs are starting to offer insurance products, and there's a lot of crossover, and insurers are out there wanting to offer checking, banking services, and so forth. And so that's the other category we think about, and that's new risks and technologies. It's helping insurers digitize. There's a huge number of things that are going on in that world. Fifth, we think about blockchain and the crypto and digital asset world. That could be enterprise blockchain use cases, or it could be SaaS software that's being used by banks and asset managers to work with digital assets. And then lastly, the sixth category we think is very attractive is infrastructure and enabling technologies. So that's reg tech, cyber, big data analytics, and quantum computing, as well as cloud migration technology. And so those are the six categories we think about within the fintech world. Others will include prop tech within that, and kind of prop tech is an adjacency. And you certainly have some companies that sit in the middle of that intersection of prop tech and fintech. And so we think that's another really important and obviously massive asset class. And then just taking a step back and looking at who's funding these deals, one of the biggest trends in venture capital private equity is that public market investors recognized that they couldn't wait for the IPO anymore. There was just too much valuation increase in the private markets, and a lot of the money in the multiple expansion was being made in the private markets, not in the public markets. So Fidelity, T. Rowe Price, Wellington, Franklin Templeton, et cetera, all started making late-stage private equity investments. Coupled with that, you have traditional hedge fund investors who are also actively playing in tech in the public markets, who also decided they wanted to make private market investments to get in earlier. And that has become a slippery slope, meaning hedge fund investors and even some of the mutual fund and traditional public market investors have started to come earlier. So we're seeing Tiger and Coatue as examples in Series A rounds. And so what that's created is just a massive amount of dry powder accumulation on the sidelines, going after private markets more than any time before. And fintech is an area that has traded well in the public markets, particularly the B2B players, think Square and PayPal. And that is something that obviously the public market investors want more exposure to. There is a significant TAM, significant amount of innovation happening in this space. And that's really what's created the massive intensity. And then I would say last but not least is larger fund sizes and more LP capital going into venture and private equity. Obviously has driven more capital to put to work, and fintech is one of those subsectors where clearly private equity and venture capital players can drive returns. And so that's created this opportunity for all of us.
Right. I mean, you see that, Fidelity of the world, the public market, the hedge fund of the world coming to the private market. It's not just the fintech, right? It's actually for almost all of the private market in a way. And then there is a squeeze going on from that point of view. And I know that you actually are not as impacted because you do a lot of the early investment. So speaking of that, do you see today you are investing in very early stage versus, the public market, right? The darlings, right? The Square of the world. Do you see that there is a very different theme going on? Hey, in the public market, those are the companies that are thriving. But in the very early stage, this is the category that are, more likely thriving, in 5 or 10 years. Do you see different categories in this scenario here?
Yeah, so I would say that a lot of the public market companies, right, were for part of the first and second waves of B2C, B2SMB. And because, they're older waves and have been around for longer, they are in some cases public or going public.
The recent acquisition of the Afterpay by Square may be another example, right?
Yeah, exactly. And so you've got companies like Square, SoFi, Affirm, Funding Circle, et cetera, that are all now public companies. And they are public and, were the original players in those first two waves. You're going to now start to see B2B players going public. Marqeta, Blend, great examples. Stripe's likely going to go public end of this year, next year timeframe. And so it's time now for the B2B players to go public. And if you look at broadly the return profiles of these businesses, the ones that are more B2B in their business models are getting valued higher and are performing better in public markets versus the consumer players. So as an example, Lending Club has really struggled in the public markets. And that's principally because the public market investors look at the business and they're like, all right, this is a lending business. It, doesn't have really a lot of tech IP. We're going to value this as a balance sheet tangible book value business. And that's what's happened. And so public market investors have valued the business at a lower level than the private market investors gave the company credit for, because they viewed it as more of a technology business versus a pure balance sheet, tangible book value business. And that's what's happening in the public market. So Square and PayPal, because of their strong B2B orientation, are actually getting a significant amount of tech multiple credit, as are companies like Marqeta and Blend, versus Lending Club, Green Sky, Funding Circle, and even SoFi to a degree. I think public market investors look at SoFi and they see, a marketplace-oriented business where they're relying on lending as a significant part of their revenue. You have to remember, lending is a do-over business, meaning you're making a bunch of loans during the year, and then the minute the new year starts, January 1st, you got to start all over again. You start at zero again, right? So if you make 100 million of loans this year, next year you're not going to get credit for those loans. And so SoFi is a very difficult business to create predictability and insulation in their profile. They also tend, along with their other peers, to have lower gross margins, which public market investors do not like, right? Public market investors want to see 60, 80+% gross margins, and they do not want to see kind of 30, 40% gross margins, because those aren't very defensible. The other thing you'll see from public market investors is they not only do they love recurring revenue models and subscription models, but they're not fans of businesses that are purely relying on interchange fees. And so pure interchange business models, Marqeta is in this category, although Marqeta is actively trying to build more software to support their business and to monetize around software versus just pure interchange. And so that's another kind of knock on pure payments businesses that really struggle to add additional layers of sticky revenue. So that's how to think about it. So I would say, generally speaking, the best performing companies still in early stage, pre-seed, all the way through to public markets have more of a B2B orientation. And if you think about that, it's the public market financial investors and the most sophisticated of those versus the retail investors that are really setting the tonality. So for me, I got to look at what's happening in the public markets in order to make sure, particularly in my growth equity companies, where we're looking to potentially put more money to work, that, hey, this is going to be a company that's going to be embraced and well received by public market investors. Because otherwise, you're investing in something that potentially all the value will have been, brought in the private markets, and it won't be that interesting of a public market outcome for you.
Right. I think, that's probably why you are kind of doubling down your investment in the enterprise B2B fintech companies, right? Their gross margin, their stickiness, right? It's actually just more superior than a business model just selling to SMB or the consumer. So any conversation about fintech or financial related sort of investment conversations, probably I wouldn't do it justice without mentioning Bitcoin, right? Blockchain, that part of the market. Some people perceive that, hey, Bitcoin, blockchain, whether fluffy or not, there's a lot of uncertainty, right? And then, the market go up and down a lot, at least from Bitcoin price point of view, to say the least. And what's your point of view about enterprise software for this segment? Like, I know as a fact, you actually recently invested in a company called Unchain. It's in the blockchain part of the business. Why? What's your perspective in this market?
So I've been buying Bitcoin since 2010, and it's still my best trade of all time, but I view it as that, right? I've never been a big believer in Bitcoin as a store of value and, as a means of creating commerce. I viewed it as an asset can be speculated on, quite frankly. And the most interesting part of Bitcoin and the broader crypto space is the underlying technology of blockchain and its various instantiations and different chain opportunities that we see today. So the two areas that we invest in the space are, one, enterprise blockchain solutions. This is where blockchain can be very simply cheaper, faster, better. If you think about that, it's really use cases where there's a bunch of expensive intermediaries. So if you see expensive rent takers in the middle of a process, you have an opportunity to potentially put blockchain in their place using things like smart contracts, validation nodes, and obviously the inherent immutability and distributed nature nature of the ledger. So that's the first area. A great example of that is Figure in our portfolio, who's using their blockchain protocol, Provenance.io, in a number of different ways, but the largest of which is asset-backed securitizations. So the asset-backed securitization market, off-chain, so to speak, is a $3 trillion market. It takes 120 days over-the-counter OTC to securitize a pool of loans. 120 days. This is a market that's been around for 25 plus years. And it costs the originator. So if you're Bank of America and you want to securitize a pool of 100 million mortgages, it's going to cost you 150 to 200 basis points and take you 120 days. And the reason for that is there's 5 really expensive intermediaries sitting in the middle, and I won't go through all of them. But Figure has basically put a blockchain in place that disintermediates and takes out all 5 of them. I should say 4 out of the 5. One of them has stayed, which is the ratings agency, because you still need to rate the paper. That's pretty fascinating. And you think about other use cases like supply chain. We have a company called TradeShift focusing on that. And blockchain becomes a very powerful solution for specific use cases. Now, it's not a silver bullet. We get presentations all the time from founders that are, blockchain for X. And if you replace the word blockchain with the word database, it's a better business. And so just because, blockchain is a hot commodity and a hot technology doesn't mean it's going to fix everything. The second area is where Anchain and others play, which is enterprise software solutions for corporates and other players around the digital asset community that need those solutions from back office through to front office. And so when I think about back office, I think about custody, I think about clearing and settlement. And then if I think about middle office, I think about reg tech. And Anchain plays in this reg tech or regulatory technology category for digital assets. And a big issue in digital assets is ransomware. It is banks and asset managers wanting to work with digital assets, but not feeling comfortable with it, right? They can't diligence it. They can't do KYC AML. If they want to really track down, bad guys, so to speak, who have, issued ransomware and are using blockchain rails to try to steal crypto and using smart contracts and all these other functionalities I just mentioned that are doing good in some cases, you need a really powerful solution for effectively following them down the chain. And that's what Anchain provides. There's other players like Chainalysis out there, but what we found with Anchain is they just have such stronger technology capabilities, and they can look at mixers and smart contracts and these other areas that are new innovations. And you just got to stay ahead of the curve, much like reg tech in traditional banks. In the crypto asset world, things are evolving so quickly that you need powerful tech, AI, machine learning, other means to stay ahead of that curve. In addition to that, I would say, there's front office tools. So think about for crypto research and analytics, trading systems. Obviously, we've all seen the exchanges like Coinbase, Kraken, and Gemini, and we've seen ETFs and new products emerge. Effectively, the traditional asset management world is being replicated in the asset management in the crypto world, and that's huge. And so getting exposure to that as an investor is really important.
By the way, I'm a big fan of Dr. Victor Fan as well. It's good to hear that you have such a positive view on Anchain. One last question I wanted to discuss with you is really the global view, right? So, for instance, you know that China is pushing the digital money quite a bit. Do you see that having some impact or challenge on pretty much a US dollar dominated world in the recent few decades, to say the least? How do you see the landscape evolve here?
Yeah, so I think every government and sovereign is going to have ultimately some kind of stable coin against their fiat. I think that's inevitable. Obviously, China has already developed their own solution there. I think, obviously, U.S. dollar continues to be the reserve currency, but it's very clear that China wants to take a leadership position in that regard and potentially vie for that type of position. I think the challenge in China has been really trying to manage regulatory messaging. It's not clear from the regulators how they view crypto and blockchain. And obviously with recent enforcement mechanisms on traditional technologies like Ant Financial and Tencent and so forth, it's really hard to read. So I think entrepreneurs, even though China, from a IP perspective, is massively ahead from at least a filing standpoint on blockchain and related applications, I think in actuality, the maturity of the blockchain and crypto world in China has been challenged because the regulators really haven't given them a path and clarity on those fronts. And so I think that's how we think about it. We think that blockchain is a really critical application for governments to embrace, that digital currencies to supplement with the fiat, obviously providing the backing and the stable aspects of that is really important. And we think ultimately every sovereign is going to be able to provide for that. But if you look at where crypto has really thrived, it's actually in countries where their own home currency is highly volatile and subject to inflation. So you look at Venezuela and some of the Latin American countries, a lot of their citizens have more faith and trust in Bitcoin or Ether than their own currencies because they've been so dramatically devalued. And I think that's an interesting takeaway because obviously US, China, others have fairly stable value in their fiat and home currency. But for other countries, that's just definitely not the case. And it's not very easy to move money cross-border in those countries as well. So digital wallets serve multiple purposes.
Yeah, this is actually a fantastic talk. Give me a pretty good overview of how you think about the fintech SaaS industries. What I heard from you is this $1 trillion spend, right, in the financial industry. Only 10% of them, the spend is on the cloud. And then we expect a massive newer spending or the newer movement onto the cloud, obviously. So that give you and give all of us, an opportunity to see that the fintech, the SaaS business to thrive and to do more. And then, you also mentioned the low, even though financial industry is a regulatory business, but the fintech SaaS business is relatively speaking lower regulatory scrutiny. That's actually pretty good for this segment. And then, the business model, right? Recurring model, the, high gross margin, and then pretty light capital investment. Compared to the B2C side of the fintech, the B2B, relatively speaking, more capital light. So overall, sounds like, the private market, the public market, just to give the SaaS fintech, that part of the business more higher multiple, right? They give you more premium, value the business more. So it's actually a pretty good business to be in. It's good to hear from you that, hey, fintech is not just about B2C, right? To consumer kind of the business. There is so much money, so much spend, so much opportunity in the enterprise. Thank you so much for taking the time to chat with me about fintech SaaS business.
My pleasure, Howie. So good to be with you and look forward to future conversations.
Okay, thank you. Have a nice one.
这期 What's Next 科技早知道就到这里了。听完之后，如果你有任何的想法，欢迎在评论区里面给我们留言，我们每一条都会认真的看。如果你喜欢我们的节目，请记得给我们5星或者好评，分享给更多的朋友，也会对我们非常有帮助。你也可以单独写邮件给我，邮箱地址是ting@声.fm， 我都会一一回复。那同时公众号和微博也可以搜索声动活泼，声是声音的声，节目相关的更多信息会在公众号里出现，微博和公众号都会有不定期的福利给到大家。如果你想要跟我们更加紧密的讨论和分享，或者是想要认识和你一样有求知欲的新朋友，可以加入我们的微信群。进入听众群的方法是在公众号文章中扫码添加，或者是公众号后台回复科技早知道即可获取邀请码。期待你的加入，我们下期见。